Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring investor, or maybe you are an industry insider, well, you're in the exact place that you should be because on the Gray Report we touch all areas of the multifamily industry, and we have two great guests here with us today. Both are from Berkadia, Jonathan Rappa and Noah Stone. I wanted to go ahead and just bring them in because they put out a really interesting report several weeks ago that's a little bit different from a lot of the other reports that we feature on this show. And we thought it was so interesting. We wanted to reach out, bring these guys on the Gray Report to really kind of break it down and really so everyone can really understand it. And again, it's just another piece of useful information to help everybody make better decisions. So without further ado, Jonathan Rappa and Noah Stone, really appreciate you guys coming on the show. How are you guys doing today?
Doing wonderful. Thanks for having us.
Thanks for having us.
Absolutely. So I'm going to give you guys a kind of a quick intro. So Jonathan, you've got over 10 years of experience in commercial real estate and is the Senior Director of Business Operations at Berkadia, Berkshire Hathaway and Jefferies Financial Group company. Jonathan oversees three verticals within the Berkadia organization: research, financial analysis, and the junior producer program. Noah, you help lead the thought leadership at Berkadia, a Berkshire Hathaway and Jefferies Financial Group company, and he has a background in CRE analytics, where he has conducted research and analysis for San Francisco-based area firms like Twitter, SurveyMonkey, Chime, Prologis, and Genentech. He is affiliated with the Council on Foreign Relations as a young professional, where he engages in discourse with the council on matters of global business, among other topics. Guys, very impressive backgrounds. You guys are in a really interesting space. Jonathan, maybe starting with you, can you maybe just tell us outside of your bio kind of what you do at Berkadia and what you're focused on?
Yeah, I'd be happy to. And like I said, Spencer, thank you for having me on here. Definitely excited to be part of the podcast today. So like you were talking about for my bio, I oversee mainly our research department, and that's really broken up into a couple of different parts. We have our production research team that really works on our deals and our OMs and BOVs. And then we have our thought leadership side, which is the side that I'm really excited about. This is the side where we're going to be talking about today. And we're really trying to build out thought leadership that is thought-provoking in this industry. And then in addition to that, I also oversee, like you mentioned, our junior producer program. That's really rewarding. We get to see new producers come in and grow their business and ultimately be a member of Berkadia. So that's a little bit about myself, and just want to thank you again for having me on.
No, absolutely. Again, excited to have you guys here. Noah, how about, just a little bit again, what you've been up to and what you do at Berkadia more specifically?
Yeah, sure. And just echoing what Jonathan said, thank you, Spencer, for having us on. We really are truly excited about this because we think we're doing stuff that a lot of the other market participants are not doing. So we're really excited about it. So as you mentioned, I help lead thought leadership at Berkadia. We're a Berkshire Hathaway and Jefferies Financial Group company. And I have a past in commercial real estate analytics, where I did work primarily with our Twitter account and Genentech, which is a Roche company, pharmaceutical firm, and Prologis and other things like that, where I help those firms navigate the seas, if you will, of commercial real estate. But my position at Berkadia is very exciting to me because what we're doing is really we're at the cutting edge of setting a new standard of sophistication, we think, for the whole commercial real estate industry's research arm. And that's definitely something that we're proud of. So my day-to-day is really thinking about new and innovative and fresh ways to think about commercial real estate, and particularly multifamily, more from objective points of views rather than subjective points of views. One of our unspoken mottos, if you will, is we want to be more rigorous, not less rigorous. We want to heighten the intellectual curiosity of the entire industry, and hopefully that'll permeate through to other industries as well.
Yeah. Well, that's really exciting what you guys are doing because in the past, well, and in general, real estate, typically lags behind, many other industries in terms of its sophistication level, use of technology, and, in terms of, market analytics, it being a much more opaque market than, the stock market, for example. There's a lot, less option for price discovery, just a lot less information and data out there, and that creates a much more inefficient market, which for investors, we can take advantage of those inefficiencies, but you really can only do that either if you have direct knowledge, which to your point may be very subjective, or you actually have the analytics and really that objective information that maybe other folks don't have. But really, kind of to your point, you're bringing that sophistication, to the industry, and that's what really kind of stood out to our team here at Great Capital when we saw this report on multifamily return volatility and why it matters. It was a very unique piece. It's not like a lot of the other pieces that a lot of the other research firms, brokerage firms, analytics firms put out, which are it's good, great information. What they do, Berkadia included, but it's often the same KPIs. Rent growth, maybe employment growth, occupancy, which is, again, good to have. It's important, but it's very surface level. It's really not technical or too analytical. So, tell us why, focusing on understanding market beta and return volatility in multifamily, why did you guys choose that topic to really kind of get into? And then, as you're explaining it, because I'm not an economist. I know a lot of our listeners, they're multifamily investors. A lot of this, they may not be familiar with these terms. You could kind of break it down in a way that, your typical, maybe even newer investor could real easily understand.
Yeah, I'll start us off here, and then I'll let Noah go. And I think it would help also to understand who Berkadia is as a firm, and then kind of get into how we came up with this topic. So first off, Berkadia, we're a full service real estate firm. And what I mean by that is we really offer an integrated platform for our clients. So whether that's investment sales, debt placement, or loan servicing. And then, what I always say too is we truly want to represent all clients across the commercial real estate spectrum, but we definitely are focused on the multifamily industry in particular. Now, with saying that, I think how we kind of came about this topic of beta was to what you were saying. I've been in this industry for over a decade and in the research form for nearly 8 years here at Berkadia. And like you said, a lot of KPIs out there, but it's the same thing kind of over and over again. What's rent growth? What's supply and demand? What's occupancy look like? And I thought it looked like there was a gap to me on what other industries were doing, like the equities industry over on the stock side, what economists are doing. I said, hey, maybe we can marry some of those ideas and bring those over to the commercial real estate realm, because really there is kind of a lack of that kind of more rigorous intellectual type of research. So that's where this idea came from. Noah and I have worked together very closely in developing a lot of our ideas. And this was one of them that we were really excited about. We identified some sources of data that we could use to measure beta. And frankly, I think it's something that really investors these days are clamoring for, right? Yeah. Everybody's becoming more sophisticated in how they invest in commercial real estate. So the same KPIs are not always going to be as valuable. If you really want to stay ahead of the competition, there needs to be a deeper analysis going on. And I'm going to just mention one more thing. I want to make sure that, what we do and what we produce, it's not just intended for the academic, members of our industry. We want to take these complex models and analyses and really distill them down into actionable insights that the common multifamily practitioner can use to execute in their work life or in their investment strategy.
Yeah, no, and that's what's exciting about this piece, is because that was clearly part of the goal. And so, let's just get into it. Multifamily return volatility. Why does it matter, Noah? What's the point, and what is that?
I think, So I think that what would be useful is if we set a solid foundation for ourselves. I think a lot of people think about return volatility in the absolute sense. So they think, okay, the extent to which returns over time fluctuate, that's return volatility. If I have a sense of the amplitude of my return wave, if you will, then I'm all set for my assessment of volatility, and that's just not true at all. So the other way of looking at volatility, two main ways: absolute volatility, relative volatility. The main measure of relative volatility is this concept of beta that we're talking about. And most of your viewers are probably familiar with the measurement, which is beta, in the context of equities markets. So you'll hear that, most recently during the pandemic, during the early onset of the pandemic, Zoom's beta coefficient as it relates to the S&P 500 went from positive to negative. So negative beta meaning good news for the market is actually bad news for Zoom, and bad news for the market is actually good news for Zoom. So that beta inversion, as you'll hear it in the news, which happened during the early onset of the pandemic, is an asset or equity beta in the context of stocks. But what we do here, which is very unique, is we apply the concept of beta, the measurement of relative return volatility, to the apartment market. So rather than using the S&P 500 as our benchmark, we use the national apartment market. So how you interpret our beta coefficients in the context of our research here with multifamily return volatility and why it matters is in the following way. So suppose you ask the question, if national apartment market returns rise by 1%, by how much do, let's say, Phoenix returns rise? And that would be a rise in the average return of Phoenix. And that number is around 1.3 for a recent perspective. So I think also, just before we move on, we should classify the different domains of beta. So we can think about, we can just ask yourself, well, first of all, what values can beta take on? Well, theoretically, it can take on a value from negative infinity to positive infinity. But in reality, we don't get very far to those infinities at all. Yeah. So in our analysis, when we look at the rolling beta over time, the lowest value is around -3, highest value is around +6.
Got it.
So then if we move into, okay, what is a beta greater than 1? That is a market, in our case, an apartment market, which is serving as a vehicle of leveraged upside. So movements in national apartment market returns are amplified in a market with beta greater than 1. Beta between 0 and 1 is a market which is serving as a vehicle for a defensive position or a shielded position. So movements in national apartment market returns are dampened in a market with beta between 0 and 1. And those are the only two cases. We see negative betas are extremely rare, especially in the case of real estate.
Yeah, no, that makes sense. Now, I'm just curious, when you're talking about, multifamily returns, and so you're using kind of that national average of returns, how do you go about in determining, I guess, what metric are you using for returns? Are you using, cap rates, or I guess what method are you using to determine returns?
So we're excited to use increase returns. So. Okay. That is seen as a very good source of return data. What's really special about increase returns, the reason we wanted to use those returns, is their total return metric, which is on a quarterly basis, consists of the total return, which is the income return, plus the capital return. Other sources only look at capital returns. Yep. Much of the time, so we wanted to capture that full return each quarter.
Now, does that limit you to, most primarily the kind of the gateway and primary markets, or are you able to still kind of get data kind of across the spectrum?
Increase offers a wide variety of markets. We're definitely not limited, but in this particular research piece, we wanted to look at 6 key markets that are talked about a lot, that are monitored a lot. So, Phoenix, Los Angeles, Chicago, Houston, Seattle, DC, but we're definitely not limited. And I'd like to say to you and your viewers, we plan to continue our analysis. So please stay tuned if this is something that's of interest.
No, absolutely. I know certainly we will, and I think a lot of other folks will as well, because again, I think that the market is very hungry for data and information, and that's just what we've seen. Us putting out content and aggregating content, there's just huge demand for this kind of unique information, research and analysis. So I'm curious. I want to get into, you guys, you selected 6 markets, very popular markets for investors: Phoenix, Los Angeles, Washington, D.C., Seattle, Houston, and Chicago. Out of those markets, it seemed like some behave very differently from others, especially looking at Phoenix compared to Houston compared to Chicago. Could you either Jonathan or Noah kind of discuss some of those differences and really kind of what you discovered between the different markets?
Yeah, I'd be happy to tackle that one, Spencer. So an interesting thing about beta is that it's non-constant. So that's the first thing that I think our viewers need to really internalize. So when you think of a beta coefficient, we're simply computing that relationship over a specified period of time. We can do that for the most recent 4 years, which we did. We can do that for a historical period, which was Q4 88 to present, very, very large historical period, relatively speaking. So it's going to vary. Let's say if we were to look at 4-year chunks over time and move 1 quarter at a time, you get that change in beta.
Yeah.
So some betas are relatively stable. And that's not to say that they're small or large or anything in between, but that's to say that the fluctuation of the beta itself is dampened. So Chicago happens to have the most stable beta.
Yeah.
That's not to say the smallest, but it stays about the same, relatively speaking. Then you look at something like Seattle. Seattle has a much higher tendency to change its beta over time, and you can see that empirically if you look at that non-constant beta chart. But beta itself is a very important thing to look at. If you look at, let's say, Houston's beta, historically, Houston's beta was between 0 and 1. So it's a defensive market, quote unquote. But if you switch your perspective from historical to recent, all of a sudden Houston's beta is in line with Phoenix and Los Angeles.
Yeah.
Which makes sense, right? Investors now view Houston as this leveraged upside potential market, somewhere where you can exceed benchmark returns and where you can make a good ROI. So that is the case with Houston. So my main point that I want to drive home is that beta changes over time. 4 years now, if we look at beta 2 years from now, it's going to change. And there are some macroeconomic implications for beta. For example, just briefly, during times and after macroeconomic contractions, we see a homogenization of beta coefficients, which we thought was very interesting.
Yeah.
And then the heterogeneous nature of beta coefficients, that is to say that they're all over the place, they're relative to one another, tends to occur during times of recovery. And right now, we're actually in the time of homogeneity. So they're a lot closer together than they were before.
And then you would anticipate, though, that they would diverge from this point on, and you see that being driven just by significant economic events and the entire market moving more or less in lockstep together. Is that kind of the more or less the causation of that coalescing?
I don't want to speculate on the exact drivers of that.
Yeah.
We would need to run additional analyses to really nail that down objectively.
Yeah.
But what you can see are coincidences. So single family home prices declining tended to coincide. But then there's an exception, recently that actually is an exception. So it's not perfect every time.
Yeah, no, certainly. I mean, and it's we can try to do our best, as often as we can. And some of those other drivers besides single family home prices, and I think we're on the same topic. But when you guys get into some of these other drivers of beta, you list real GDP, inflation, PCE, single family household estimates, Case-Shiller, the Wilshire 5,000 to GDP, as well as kind of cap rate and treasury yield spreads. So, and we were having a little bit of a we were trying to really understand kind of this piece of the report. Can you explain kind of how these other drivers potentially affect beta, or at least, I think it's worth at least tracking the correlation, it seems. But yeah, I guess just what you guys were able to see from that.
Yes. So it's a fantastic question, and I think we left it for the last part of the report for a reason, which I think you're picking up on, which is that it's important to know what are what the co-movements are between beta risk and in certain markets over time. We're talking about that rolling beta now, computing it every 4 years, and just bringing it down into words. What we're really just saying is how does a market is a market providing leverage upside potential? Is it a shield? Is it negatively related? So on and so forth, in terms of its returns relative to the national apartment market over time. How does it change? So that's it. That's it in words. But that analysis at the bottom is really trying to quantify the co-movements between six main factors. You mentioned, we have real GDP, we have inflation, PCE, we have the Buffett indicator, which is the extent to which the U.S. stock market is overvalued as a proportion to nominal GDP in the United States. And what we found are some pretty surprising results. The first is that in Seattle and Los Angeles, inflation is a strong positive driver now of beta risk. So as prices have been rising, so has beta risk in both Seattle and Los Angeles recently. And that relationship does not exist anywhere historically. So that's a stark difference. Yeah, and what's cool about the chart at the bottom is you'll see the one on the left is mostly blue and gray, which ignoring the signs of the co-movement, it means all these metrics are pretty much weak drivers or indicators of beta risk. But then if you switch from historical to a more recent point of view, more recent defined specifically to be a 4-year period, most recent 4-year period, the whole graph lights up, right? And a lot of it is yellow. So that leads to my next point, which is that single family home prices and the number of US households are also becoming more important indicators of beta risk, in the sense that their co-movement is positive. So over the past 4 years, rising single family home prices has coincided with rising beta risk in markets like Phoenix, LA, and DC. And that is also something definitely to keep our eyes on. And then one other thing that I think is very interesting for viewers is that you can have anomalous findings as well, like in the example of Houston's 4-year chart down there at the bottom of our report. You'll see that it's red for inflation. So as prices have been rising, Houston's beta has actually been declining. That definitely is an anomaly in our analysis. But it's interesting to see how all these different markets. I agree with you, Spencer. It's interesting to see how they all kind of fit in.
It's so fascinating, and it's always interesting to see how different markets perform in different market conditions, and just the different drivers. And and Houston has a lot of unique drivers, being so closely tied, or at least in the past, to the petroleum industry, the oil industry, and they just have some other unique factors there, less zoning restrictions and things like that. But it's really fascinating. If there was one kind of really key takeaway that an investor could take away from from this piece, and if they're trying to using beta for their own analysis, and first maybe let's say what I think it might be, but then I want to hear what your all thoughts would be as well. The biggest use I see for this is really, when we look at, portfolio construction, from a macro standpoint, and when we're looking at, building a macro strategy of, selecting markets and trying to develop a risk profile for a strategy, for an investment strategy to build a portfolio, without having kind of this information and understanding, what that implied, volatility is, what the beta of certain markets are. You're making decisions more or less in the dark. Not that you still can't you can't get more or less a subjective feel for a lot of this information, but you really can empirically really suss it out in a way to make informed decisions. That was my kind of key takeaway, outside of just what the different drivers of risk are in different markets to be aware of. But just curious, Jonathan and Noah, what you believe, kind of what are maybe the one or two key takeaways from the piece?
Yeah, thank you, Spencer. And I would agree with you. I think the key takeaway, and I think Noah will agree with me too, is really looking at this from more of a macro standpoint. If you are building out a strategy as an investor in multifamily, a lot of times it's opaque of what markets to invest in. You're looking at different drivers, and trying to look at that all on level playing field can be really hard because markets are all different. But when you look at beta, it's a constant between all these markets. Then we can start building a portfolio, whether the investor wants to be more aggressive or more defensive, and really be a better informed investor moving forward in their professional work life. So that's the big key takeaway for me, and I'm sure Noah has some thoughts as well.
Yeah, what do you think, Noah?
Yeah, Jonathan, I think that's spot on 100%. I think one of the biggest things that we're trying to remedy by putting this piece out there and sparking the intellectual curiosity of sorts of those in the industry is because we think that there is this trend of looking at things in a myopic way, where we're only looking at, like I said in the beginning, absolute volatility, and we're writing it off as we did our job with volatility. Everybody, this is the market or whatever. What we're trying to say is volatility is much more in depth than that. This report is not an exhaustive take on volatility. So for example, the reason we include likelihood analysis in this report, and we say, hey, this market has an X% probability of achieving a positive return, a Y% probability of achieving a return above the national average, so on and so forth, is because there are limitations in absolute volatility. And the thing that I like to think about for demonstration purposes is, if you think about a market A and market B, market A has a series of all positive returns, market B has the same series of returns, but they're all negative, so they're the same exact numbers, just flipped, just negative. And those two markets will have the same exact standard deviation. So they'll have the same exact absolute volatility, and that's just an artifact of the actual math behind standard deviation. But the point there is, you'd say, well, they have the same standard deviation, and standard deviation is a measure of the amplitude of the returns over time, and so I should go with the high standard deviation portfolio. Well, no, because the market with all negative returns is a really bad market to be in.
Yeah.
So now we have to ask ourselves, well, hold on, what's the probability that that market achieves an above average return, a negative or a positive return? Probability of that would be zero, obviously, in this perfect sense. But the point I'm trying to drive home is that people need to view volatility in a much more comprehensive way than they are viewing it now. And that's really what we are trying to foster in the community.
Well, and it seems it's similar to a lot of the criticisms of modern portfolio theory. Really not painting an actual complete picture. Just treating absolute volatility and just with a blanket, a much more surface level view, of potential risk and returns. So that was incredible, guys. I'm just curious, what are you guys working on now? Are there anything that we should be looking out for? Any new angles, kind of along the same veins? But what can folks expect from Berkadia and your team in the future?
Yeah,
if you can share.
Yeah, definitely. And thanks for asking that question. I'm actually going to let Noah talk about what our next piece is. It's something we are very excited about, and definitely keep an eye out for it as we develop it and release it in the very near future.
Yeah, thanks, Jonathan. Yeah, so Spencer, we're really excited about this next piece. I may be more excited about this next piece than the beta piece, but maybe it's on the same. Actually, I don't want to discriminate against our beta piece, but it's exciting because we're going to look at inflation. Everybody's talking about inflation, right? I think I saw you did a video on inflation as well, and everybody's talking about inflation. Everybody's talking about the idea of an inflation hedge.
Yeah.
But again, we're in a realm of things where the commercial real estate space is doing itself a disservice for viewing inflation's impact on multifamily and commercial real estate in general, and again, a very, to use the same word, myopic way. So what we're going to do is we're going to look at more advanced methods, quantitatively advanced methods, to assess a market's capability of being an inflation hedge. And we're going to really figure out what the true impact inflation has on multifamily, and we should come out with some really interesting insights that have not been out before.
That's great, because I think that's very much kind of on the top of, not just multifamily investors' mind, but just investors everywhere and just individuals. Like you mentioned, a lot of people are talking about inflation. I don't think it's very well understood, because it's very easy to, I think, oversimplify, prices going up. And then, to your point of, multifamily real estate being a hedge against inflation, at the same time, real estate and specifically multifamily rentals are also a major driver of inflation. So, is it really kind of the tail wagging the dog or the other way around? So really looking forward to that piece. Really good stuff. Jonathan, what's the best way to, I guess first, what's the best way for individuals to find these reports? And then what's the best way for folks to get in touch with you guys?
Yeah, great question. So the best way to find these reports and to continue to get them is to subscribe through our website, Berkadia.com. There you can sign up for our research reports, and you can select markets or topics that are interesting to you to follow, and those will be sent out as we produce them. And then from there, to reach us, we can be reached through our email addresses, which I'm sure maybe you can link in this video at the end. And we're always happy to talk about these topics and or any topics really that are relevant in our multifamily industry.
That's awesome. How about yourself, Noah? What's the best way for folks to get in touch with you?
Yeah, I second everything Jonathan said. LinkedIn is a great way. Please follow the link that Spencer's team puts in the description. Stay in touch with us. Feel free to reach out to me on LinkedIn. We can have a conversation about the piece or about something else. We want to really foster this intellectual curiosity in the industry, and we really think we're leading it in this respect. So we're really happy that we had the chance to talk to you, Spencer, about this.
Absolutely. Well, I think I want to thank both of you. One, coming on the show, but also for really raising the bar, for the industry in this type of analysis and research. It's very much appreciated. Not just by us, but I know a lot of other investors, individuals who follow the space. I'm sure you guys put out these reports sometime. I don't know if you get a lot of feedback. I know there's a lot of people who appreciate it, and so we just wanted to make sure you guys know we very much kind of appreciate the work that you guys do. And so, and again, if anybody's in multifamily space, definitely get in touch with Berkadia for their full service of real estate services. Definitely have a great nationwide footprint in team. All right, Jonathan, Noah, this has been a great episode of The Gray Report. Thanks again for coming on, and hope to see you guys soon.
Thank you, Spencer.
Awesome. Thank you, Spencer.